Hello, online ag economics students. This week we are looking at the second part of chapter 9, and we're going to cover the concepts remaining in this chapter that we did not cover last week. A few of the terms and concepts that we are going to discuss are listed here. The first is dead weight loss, monoposonistic, oligopsony, monopsony, and then we're just going to talk about various governmental regulatory measures that are taken against some of these market structure types. So to start, just as a brief review before we get into some of the new concepts, we need to refresh our memory on what consumer surplus means, what producer surplus means, and what total economic surplus means when we are dealing with perfect competition. So if you recall, under perfect competition, the point of equilibrium exists between where supply meets demand, where the supply meets the demand curve. So the price under perfect competition would be right here, and the quantity produced under perfect competition would be right here. In order to find the consumer surplus, we are going to calculate the area for everything that is below the demand curve and above the price line. So in this example, what we have in red here, the area of all of that triangle would be the consumer surplus. For the producer surplus, it is everything that is below the price line and above the supply curve. So everything that I have in green here. So we can see under perfect competition, the producer surplus, and I'm going to write that out. This is the producer surplus. And the consumer surplus, which is up above, is exactly equal. So both the producer and the consumer are benefiting equally as much. And then the total economic surplus is the addition of the area of all of these. So together, the consumer surplus and the producer surplus make up the total economic surplus. The greater that the total economic surplus is, the healthier the economy is, and also the more equal the consumer and producer surplus is, the more balanced the economy is as well. So those are just a review of those couple of terms. So that's what the previous slide shows us, what consumer surplus, producer surplus, and total economic surplus look like in under perfect competition. But this chart here, what we're going to look at here is what each of those things look like under a monopoly. So we're going to first find what the consumer surplus is under a monopoly, and then we can answer this question that's listed there. So in order to find the consumer surplus under a monopoly, we have to first remember where our equilibrium price and quantities are under these circumstances. So if you recall, under a monopoly, the quantity that is being produced is going to be set where the supply curve equals the marginal revenue curve. So that's how we're going to figure out the quantity that we're going to produce. And then we follow that quantity up to the demand curve. And at the price that the demand curve meets that's going to be our price. Okay, so we still follow the same rules in the sense that the consumer surplus is the points that are above the price and below the demand curve. So we can see we're looking at a much smaller triangle in this example, whereas the previous example, remember our equilibrium point was right here where the yellow is, and the consumer had all of this yellow surplus too. So the consumer surplus has shrunk, it's become less. It's only the area of this orangish red triangle here in the monopoly. So when we ask, are consumers better off or are they worse off compared to a perfect market? They are worse off because their consumer surplus is less. Because again, in the previous example of the market equilibrium, the consumer surplus was this entire green triangle, and now the consumer surplus has shrunk to this reddish triangle here. Okay, so we'll move on to the next question that is listed. So what is the producer surplus underneath a monopoly? Okay, so again, we set our quantity where supply equals the marginal revenue, and we follow that up to the demand curve and over to figure out our price. And the producer surplus in this case is the area, again, above the supply curve, below the price, but we have to stay within the quantity that we are producing. So it does not include areas 1 and 2 here because that is the revenue that would be brought in by producing greater quantity. So we do not count those 2 areas because that's higher than the quantity that we're actually producing. So what we do count though is this kind of quadrilateral area here. Okay, so this now is the producer surplus underneath a monopoly. Now, to recall the previous point when we were under perfect competition, producer surplus was this area here in purple. So we gave up the area of 0.2 to gain the area that has a 5 and a 4 under it, the area of 5 and 4. So the producers better or worse off in the monopoly compared to the market? The producers are better off, okay, because they lost this small point here where 2 is, but they gained 4 and 5, okay? So what is the total economic surplus under a monopoly? Well, this was, let me erase this part here because we don't have 1 and 2 there. Actually, I'll just redraw that. So this was our producer surplus. This was this top part was our consumer surplus. So the entire economic surplus is the same as what it was for the perfect competition minus the area of 1 and 2 here. So is the total economy better off or worse off compared to the perfect market? It is worse off because we no longer have 1 and 2 calculated into our surplus. So you can see the effects of monopoly on the total economy. Overall, the economy is worse off because of monopolies, but the producers are in better shape and the consumers are in worse shape. That area, the 1 and the 2 that were part of the economic surplus under perfect competition, now they are not in consumer surplus and they're not counted in producer surplus. We refer to that as the dead weight loss. So that's the difference in total economic surplus when changing from a perfect market scenario to a monopoly scenario. So we lost the area of surplus that 1 and 2 are designating here. We call that a dead weight loss to society in terms of market dollars. Okay, we're going to switch gears a little bit and talk about imperfect competition from the buying end. So in the first part of this chapter, we talked about how sellers can have, we can have many sellers, with uniform products, and that would be perfect competition. We can have many sellers of similar products that are slightly differentiated, and that was our monopolistic market. And then we can have oligopoly markets where there are a few different sellers, and then we could have monopoly markets where there was one seller of a product. Now we're going to switch gears and talk about buyers. So we have multiple types of market structures that are that have different numbers of buyers in the market. So, for example, we could have one buyer in the market in the example of a meat packing firm. So it's possible that there's maybe only one buyer of beef cattle in a regional area because they could possibly be the only meat packer in the region. So that's an example of having one buyer. So they may have an influence of the price that they will pay for the product simply because they're the only ones that the beef farmers can sell their product to. Oftentimes, a large number of farmers do face a single or just a few buyers for their product, and that has a lot of implications as we go along. So we'll talk about those different levels with the different number of buyers. So the first type is monopsonistic, and again, we're talking about from the buyer's side. And monopsonistic is the market structure where many firms are buying, but they are capable of differentiating their services to producers from who they are purchasing by the location of processing facilities, their willingness to provide credit or technical assistance, and personal characteristics of the buyer. So there are a lot of buyers, but they differentiate themselves. So that is similar to the second tier of market sellers that we talked about earlier in the chapter. So we can also have oligopsony or oligopsonist buyers. This just means that there's a few or just a couple buyers in the market. And then finally, we can have monopsony or monopsonist buyers, which is where there's only one buyer in the market. So this means that the buyer's actions directly and substantially influence the price of the product. So because there's only one buyer, if the buyer buys less of the product, the demand for the product is low and the price drops. If the buyer buys more of the product, then the demand for the product is high, so the price per unit increases. Okay, and this all is going to have an effect and an influence of pricing, which we'll look at that on some graphs as we go. So this slide is basically just saying that determining the quantity of how much these buyers will buy, we'll look at how that is determined. We'll look at that on a graph with the quantities and prices. But under all of the three types of buying structures that we just went over, those are all going to be the same, whether it's oligopsonist, monopsonistic, or monopsonist. They're all going to be the same. Okay, so I want to look quick at the input supply curve, which we've looked at. This came out of chapter 6. I just want to kind of refresh your memory on this so that we can go forward and look at the how much will be purchased from these market structures and what the price of them will be. So referring back to the input costs in a perfectly competitive market, if you recall the input costs, so in this example here, the input costs was just labor, it was wage rate. The input costs remain the same, $5 an hour, regardless of how many hours were being purchased or paid for. That is the situation we get when something is perfectly competitive. So the wage rate stays consistent regardless of demand, for individual demand, because these individual firms do not have a huge influence on the input price rate, because there's many firms in the market. So we see the wage rate stays the same regardless of how many hours are demanded. This is different in an imperfectly competitive market. The input cost will vary with demand. So we're going to see that in a second. So we can see here that if we demand 1 unit of input, that price will be $3. As demand increases, we see here 10 units, the demand has increased. Now the price has increased. And that is because we're dealing with very unique buying situations where there's maybe only one buyer in the market. So if that one buyer changes its demand, the price of those inputs that are being purchased are going to change. So our input, our price per, so our supply of input line over here on the graph corresponds to the increasing price with increasing demand. And the marginal input cost curve, what's listed here in the purple, has to do with how much is one more unit of labor or one more unit of input going to cost us. So this is why our input supply curves look different in an imperfect market than in a perfect market. And we can see all of that here. And our final goal with some of this information is going to be to figure out what the profit maximizing input level is. And in order to do so, we're going to look at the marginal input cost graph and a couple other things we're going to put together in the coming slides. So in order to find the profit maximizing input level for imperfect competition, we need to look at the point where marginal input cost equals marginal revenue product. So here's our marginal input cost, here's our marginal revenue product. So at this point right here is where we are going to figure out what quantity we will be producing. So, or we will be, purchasing. So this is what we will be, this is the amount of input that the buyer will be purchasing. Now the price of the input is going to be determined by the corresponding point on the supply curve. So we drop down to see that this quantity crosses the supply curve at price equals M. Now, if we were going by perfect competition, again, the supply curve, the demand curve, the marginal revenue product is similar to the demand curve. The quantity that we would be producing is here, and the price that we would be charging is here. So in this situation, we are charging less money and we are producing less product than we would be in a perfect competition in this particular situation. Okay, this slide just tells you what I described on the previous slide, where your input quantity and price would exist in perfect competition. We're also going to skip this diagram as well, but this is on page 166 of your textbook. if you kind of want to look at what's going on at the different levels of market in terms of whether they're perfect competition, whether they're oligopolists, whether they're monopolies, and so on and so forth at the different levels. Okay. The final section of your book talks about some governmental regulatory measures that have been taken to prevent both oligopolies and monopolies from really having a super negative impact on our economic health, because as you saw before, the kind of the dead weight loss is something that we really want to prevent in order to maintain our economic health. So there are legislative acts that have been passed. There are ceiling prices that can be designated to certain products. There's lump sum taxes that can be given to companies, and there's minimum prices that must be charged for certain things, that the government can kind of intervene and make sure that oligopolies and monopolies do not wreak, cause major havoc on our economy. So just to look at a couple of the legislative acts, the Sherman Antitrust Act basically forbids price fixing and collusive agreement. Also put some legislation against monopoly. In 1914, the Federal Trade Commission was established to carry out the provisions of the Clayton Act. And the Clayton Act just sort of updated and plugged some loopholes of the Sherman Antitrust Act. Later in 1922, the Capper-Volstead Act established cooperatives, which cooperatives are kind of farmers' bargaining associations whose goal is to improve the producer income through either higher prices received for their products or lower prices paid for inputs. So that's kind of an overview of some of those acts. There's some more legislative acts that your textbook talks about on page 168, and you can use your text to read about some of those. The text also talks about marketing orders, and marketing orders, this is kind of the biggest point of them, is that historically the federal government, if they want to control the quantity of a particular product coming into specific markets in order to maintain a price for the product, they may prohibit the amount coming in. This hasn't happened, but it's talked about, putting a quota on the amount of dairy milk coming into the market, because we have a ton of dairy milk in the market, and our prices for that milk get lower and lower, obviously, if supply gets higher and higher. So the government could step in, establish a marketing order, and say that we can only produce so much milk, and that would maintain that milk price. In general, a little bit more information on the bargaining associations or the cooperatives. Generally, they don't have very much success. Then there's a lot of challenges, because in order to be successful, they'd have to control, they must be able to gain control over the whole supply. A lot of producers are not sure that they should join the bargaining association. The bargaining association is not able to control substitutes or imports of that product. And then finally, if success is achieved through a product price increase, some producers then may be tempted to leave the bargaining association, take those higher prices, and then eventually, they're back to square one. So you can read more about the bargaining associations on page 167 of your textbook. So there's a few other governmental regulatory measures through, there's a ceiling price that they can put on, the Federal Trade Commission can institute basically a maximum price that a monopoly can charge for its product. And what that is going to do is that will actually reduce the profits of the company. So if we're looking at here's the marginal cost, here's the marginal revenue. So the place where marginal cost equals marginal revenue, that's the quantity that this company is going to produce at. Then we're going to follow that line up to the demand curve. So B is the price that they would set if they had the choice. Now the government comes along and says, actually, you cannot set your price at that level. You can only set it at this level. So now their original profit of, let's see where their cost is. Here's their cost. So their original profit, here's above the average total cost here at that quantity. Their original profit would have been this box, the area of this box. But since the government came along and said, no, you can only charge this price, now their profit would only be the area of that box. So that's the effect that a ceiling price can have on profits of a monopolist buyer. The government can also put a lump sum tax on a monopoly, and this would just charge, a one-time license fee or a fixed tax on the company. So basically what that's going to do is that's going to raise their average total cost. So in this case, it's going to raise their average total cost from point C to, well, these aren't really labeled very well, but it's going to raise from ATC1 to ATC2, and that's going to reduce their profit. Their original profit was this whole square here, and now they're going to take out that section because they have to pay this much more in tax, and now their new profit would be the yellow mark. So a lump sum tax results in loss of profit for a monopoly. Okay, with that, we are going to wrap the lecture up for this week. So read your textbook if some of these concepts are not clear. Email me, visit me during office hours. I'm always available if you need help with any of these things. Good luck on the quiz questions and the problems for this week, and let me know if you need any help. Thanks.